Hey, this is Chris, and in this video I'm going to be sharing my 3 tips for people who are investing in their 30s and 40s, as well as one common mistake I see that people make. So my first tip for people in their 30s and 40s is that you need to be not parking too much of your savings and long-term savings into cash and low-risk things. And the reason for this is pretty simple. In your 30s and 40s, you've got a long time ahead of you. You've got plenty of time to ride the ups and downs of markets, and therefore you should be taking advantage of the opportunities to earn a higher return in other assets outside of just having all your money in cash. And more importantly, if you just leave all your money in cash, you're actually going to be falling further and further behind when it comes to the things that you want to buy with that money in the future. Whether it's property or putting it towards kids' education or your own retirement, you need to be keeping up with inflation. And unfortunately at the moment, putting your money in the bank and earning 1 or 2% simply isn't doing that. So tip number 1, get your money out of cash and make it work harder for you. My second tip is actually the other side of this, which is if you are going to take a bit of risk with your money, take sensible risks. Now, it's very tempting, especially at the moment with all sorts of exciting investments showing returns of 50 or 100% in a year, to really jump onto the bandwagon and try and earn a stellar return on some sort of speculative investment. Unfortunately, any asset that can go up by 50% in a year can also fall by 50% in a year. And really, you want to be avoiding these giant drawdowns in your money to build long-term wealth. So be sensible with the risks that you take. Our tips for StockSpot clients is always to diversify broadly into different asset classes like shares, Australian and global shares, bonds and gold, so you're actually protected whether markets go up or down and can still earn a good return of, let's say, 5 to 10% per year, which is a lot more realistic. And ultimately, if you can earn that sort of return consistently over time, you're going to be doing really, really well. And my last tip, which is also a common mistake I see people make, is you shouldn't be putting all of your money in your mortgage offset account. And I have a few caveats to this one. So you really do need to make sure you've built up a good buffer in your mortgage offset account. If you've bought a house, you're ultimately quite highly geared personally. You've got a lot of borrowing. So you should be paying off a bit of that borrowing first. But continuing to only put your savings into a mortgage offset account means you're very concentrated in your personal wealth. All of your wealth is basically in one particular asset, and often that's just a single home in a single suburb, obviously in one country, and so you don't have access to all the other great investments out there that can help to counterbalance ups and downs. And so my tip would be, once you have a bit of buffer in your mortgage offset account, consider using that money to diversify your overall wealth and reduce your risk overall. And you can obviously access money that you put into a share market portfolio or a diversified portfolio to bring back into your mortgage offset account in the future anyway. And they're my 3 tips for people in their 30s and 40s.